geez, if one closes, do all the people go to another branch or do they stay with that branch? You know, and what are you the last one that's going to be selected for new accounts when they don't see the branch among five others? Unfortunately, or whatever way we want to look at it, the consumer is so accustomed to seeing that. You know, yes, guess what? Instacart could deliver every one of my groceries probably better than I shop, but I don't want my grocery store to close.
Welcome back to Breaking Banks and our special series on the new book, Branch Tomorrow. I'm here with my co-author, contributing author, Jim Marous, a frequent guest on Breaking Banks over the years. In fact, the first time he ever hosted a podcast was on Breaking Banks. And we've often...
referenced it last week. Great story, yeah.
Yeah. So, Jim, welcome back to the show. How have you been, bro?
You know, I'm doing good. You know what's really good? I've tried to take it easy over the summer and try to read some books. And I don't know if you've seen this. There's a new book out that it is. It's a bestseller. I can't put it.
It is already a bestseller. Number one in banking.
Cover to cover, 3 times. I can't get enough.
Awesome. Well, thanks for the feedback. You know, it's. Do you find it weird reading your own words in a book like that? You know, the first time. I mean, I go back and read some of my books, like Bank 4. I've read a couple of times just to keep fresh the ideas, you know, because I get questioned on it, and also Augmented, I enjoy it. And
yeah, the differences that you showed in the book with the different co-authors around different regions, I think it is interesting, but it was interesting because even though you shared the PDF version of the book, we tend to focus on our section. And I'm now reading the rest of the book, and it's interesting the dynamics of the different areas, the challenges organization are feeling. It's just kind of cool.
Yeah. Well, first of all, thank you for your contribution to the book, and it's great to be able to do a project with my friends, you know, that are all in the fintech space.
A group of friends, you know, we all
exactly.
We all kind of knew each other, so that's pretty cool. Yeah.
Yeah, so collaborators. So it's great. Now, of course, you contributed to one of the more significant chapters of the book, which is the chapter on US branch decline. And, we know, of course, that branches have been in decline since 2008 in the United States.
Yep.
That decline sped up a little bit during the pandemic. It slowed a little bit in 2022 as some of that activity came back. But on average now, we're seeing sort of that 2 to 4% decline annually in terms of branch numbers, and yet. I did an event in Austin, Texas, not that long ago for America's credit unions. And, I've done other events in the region recently where there's still very much a belief that branches still have a role to play. And, and of course, we can start with one of the debates that we had in the book. And I won't say that you and I debated this, but there was there is a debate going on in the United States right now in respect to some players who are still investing in branches, players like Chase and Wells and so forth. But globally, these are outliers. And even in the interview I did with Effie the other day, Effie referred to Chase as an example of banks still investing in the branch. Here's the key problem I face with that, though, and this is what I want to discuss, is I don't know how the economics of that even work today, let alone in the future. Chase is, pay somewhere between $350 and $450 US to acquire a customer through their branch network today, whereas Nubank is doing $5 to $7, WeBank $1. So the real problem with traditional bank architecture is that it can't scale in a digital world, and the economics, most branches are now no longer profitable. I would say my estimate would be that, and it's hard to find out the math behind this, but my estimate would be 60 to 70% of branches in the United States today are loss-making entities. And in that environment, when you've got digital...
Any argument with that, yeah. Yeah.
Right.
I,
And
I think
in
I
the
think that's right. Yeah. Go ahead.
Yeah.
I'm sorry.
So then where does it go from here? Is these movers who are still investing in branches, is it that they're adding branch numbers, or are they just, are they just resizing their network, right sizing it by taking larger branches and building smaller sort of footprint? What's the reality in terms of the mechanics? Because I don't know how it's sustainable,
Well,
with
a
those
couple
economics
things.
at play.
They're not smaller branches. At least the ones that have been built in our area, the new Chase branches, the new Bank of America branches, and the new Wells Fargo branches, are not small branches. I mean, in Chase's branch, they're standalone. They're not even in a center or anything like that. I think what's interesting is in most of those cases, including Capital One, I think they're right sizing the network. I think we've seen recently, especially, that the Chase, the Bank of Americas, the Wells, are in many cases are in a net negative position. They're simply opening branches in areas where they're not and closing where they're in areas where they're overly saturated. And I
Right.
continue to look at the fact that where
So they're
these
reporting on the branches they're opening, but they're not reporting on the branches they're closing. It's a
no, but
it's
if you
a,
look at the
a
nets, yeah,
PR
exactly.
exercise, right?
Oh, exactly right. Because it's not a feel good moment, in right sizing. What's interesting too, and this is the one that baffles me, but in the same category that you mentioned of the big banks, is the small banks. We did research this year that I referenced in the book that there are more organizations that we researched that said they're going to be adding a branch than subtracting a branch.
Yeah.
That is baffling to me. We're not talking about the Chases. We're not talking about the Wells Fargo in these cases. We're talking about small and mid-sized organizations that I think their intention, the best they can reference it is, we want to generate more deposits. I can tell you that there's not a soul that I know that thinks that generating of deposits can be done
I'll go.
more
Yeah.
efficiently with a branch. Now, mind you,
Yeah.
to your reference on Chase, they're also getting to pay that amount. You're having to open up a several accounts. They're also targeting very closely who they're going after with because of their credit card base. They benefit. Bank of America benefits. Cap One benefits because their credit card market. They can send her into wealthier areas and then try to get their credit card customers. But I can't justify. I have a hard time justifying anybody that says they want to expand their market share via a branch network. It's at $1 to $2 million a unit or
Yeah, that's the
$300,000.
thing. Yeah,
Yeah.
what's the going to be the most economical branch footprint, like a pop-up branch or something like? It's still going to be hundreds of thousands of dollars, right?
There's new.
Yeah,
They're trying to bring the new things together. Saying we're going to do this mini branch, but then I'm saying, okay, but why are so many people then saying they want a consultancy center? So you you,
right.
you can't have it both. Either have an oversized ATM or you have an
Yeah,
undersized consulting center. And
yeah.
boy, I'll tell you that as you said, the economics don't work from a dollar and cent basis, or at least put it this way, it's not the most optimal. I'll take that weak middle spot that says it's not optimization of money. Hey, look what Chase is doing. They're not only one of the fastest growing banks, if not the fastest in the UK. They're now just
Right.
announced they're going to be moving to Germany, and
Right, but they
again,
don't have branches.
not a
The
single
digital
branch.
digital acquisition, right?
Yep.
Which is interesting because you've got to then make that argument: is do they believe in branches, for sort of sustainable purposes? Well, why aren't they deploying branches in Germany and the UK instead of digital acquisition? It's because they couldn't afford to do that, and they've grown impressively. What is it? They're up to 5 million customers in the UK now, I think, something like
Yeah.
that.
It's
But at
and
the
very
same
fast.
time,
Very
right?
fast.
But at the same time, they've had to spend a lot more money than Monzo or Revolut in the UK market to get that traction, right? So,
Well,
their
you can't do it
economics are
without
still not
scale. You
great.
can't do it without scale.
Yeah,
Yeah.
yeah. Well, that's
But
the point of that's really at the core of why we did this book, right? It is the
right.
scalability question.
Okay, and so that being said, Chase is totally digital in the Europe. They're very branch based in the States. Is this an issue of the bank's mentality, or is it a consumer issue that
Market mentality.
consumers
Yeah.
will react very quickly with that push of the button if you take a branch out of their favorite spot on the street and make me go to the one that's further that I don't go to that often? Now, mind you, I may only go to the branch twice a year, if that.
If
But
that.
to, but to go further, and when I go, you know what? I go past this other branch all the time. I'll push a button. And it's interesting. I think it's a very
Well,
risky decision.
having spoken to heads of digital at one of the brands we've talked about today already, and another mid-sized, very large, bank in the top 10. And, they're telling me that 60% plus of their customers have not visited a branch in the last 12 months. Now,
Right.
this I'm sure doesn't surprise you, but here's the problem. And that if you do a customer survey and you ask customers, what is going to, what leads you to a choice of bank,
Right.
often one of the top responses is a branch near my home or my work. And
Yeah.
yet, those survey results are not translating into footfall today
Correct.
because
Yeah,
the
right.
utility of digital is becoming so good. And, look, honestly, Chase is very good at digital as well. I mean, they're spending $18 billion a year on transformation right now. So, they
Yeah.
have to be. But they've got a large percentage of deposits and account opening that's coming through digital now. It must be at half of their, new customer engagements now must be via digital. I know for TD in the US, it's much higher. Their largest cost center in terms of customer acquisition is digital for TD now. So we are seeing that.
You look at Bank of America with Erica. What a great
Right.
runway that's given them on the digital platform.
Sure.
And when you start looking at search and everything else.
So the reality is, it seems customer behavior is already shifting in reality, but the perception of customers in the US is still that I need a branch just in case I need to go and yell at someone to get access to my money, or if there's a problem.
Because they're everywhere.
So
I mean, they're still everywhere. So
yeah,
I go from our house to a center city, which is a small, suburban. There's 4 branches, 5 branches of different financial institutions on the street. Geez, if one closes, do all the people go to another branch, or do they stay with that branch? And are you the last one that's going to be selected for new accounts when they don't see the branch among 5 others? Unfortunately, or whatever way we want to look at it, the consumer is so accustomed to seeing that. Yes, guess what? Instacart could deliver every one of my groceries probably better than I shop, but I don't want my grocery store to close. Drugstores,
it's a great point. It's a great point. These behaviors are sticky. One of the other thing is there is a bit of the US market, sort of closed loop thinking here. One illustration of that I use is that if you look at most of the other G20 markets, certainly if you look at China, if you look at European markets, for Gen Zs and Alphas, 80% of their banking is done first and foremost through a wallet, and an app these days. They don't even use a plastic card. Most of them have never carried a debit card. They certainly don't use cash, and they don't even know what a check is. And so, whereas in the US, adoption of contactless is well behind. So UK is like 90% contactless. China's like 98% digital now. It'll be the first real cashless economy in the world. US is still, I think, at about 40% of contactless now.
It's insane. Even with instant pay, everything that's going on in the instant way, I was amazed by the silent lack of taking up on that technology.
Yeah.
people are still.
So, I mean, Americans are proud of that, though, right? Like, when you talk about this and you talk about what's happening in these other markets, Americans are proud of the fact that they can still do it the old-fashioned way and can still write a check. What is it? 80% of checks globally are written in the United States today. I mean, I don't know how.
I write, as you know, I write checks twice a month, and that's because I have to write a check to myself to transfer funds because the financial institution that's the origin bank doesn't talk to the accepting bank. But and
you can you write yourself a check, do a remote check deposit capture, and you're good. Money goes instead of just doing an instant transfer. It's insane.
No,
it's insane.
But that's me. But the point though you're saying, and I think we have to keep on drilling it home is just because it may be difficult to close branches, there's no justification to open branches. If you need deposits, the hardest way to do it is in a branch-based environment.
Absolutely.
The easiest way to do it at a whole lot less cost is to, number one, fix your back office so that when you open an account, it can be opened almost instantly. You can't have a 13-minute process because you're going to lose from our research, 60 to 65% of the business that would have come to your financial institution won't if the process takes more. If they have to do it outside of a phone, they want to do it with a few clicks, and it's not hard to do. You just got to do things. When you do that, and you start going after some digital marketing, you'll increase your deposit growth. You'll more than triple it. It's going to happen.
Yeah.
Don't build a branch. Now, as you said, we debated in the U.S. section because what do we do with all the monstrosities everywhere else? Number one, don't take your lead from the biggest banks. They have a completely different metric than we know how to work with. And I doubt if Chase is losing money.
They're happy to have all of these empty branch billboards around the place to build trust, right?
But on the other hand, think about your allocation of where you need money to be spent. And it's not in the physical structure. There's just no way I could justify it. I know you've talked to Ron Shevlin. Every one of the people who contributed to the book, no one can make a case for why you have
shout out to Ron Shevlin. When are you going to interview Jim and I on the new book, brother? Okay.
There we go. Yeah.
No, it's all good. Look, Jim, I'm conscious of the time, but let's talk about some of the mechanics here. You do a lot of advisory work in the space. You're speaking at events all around the world, of course, about banking transformed. How do we change the culture within the US? So, and I think some of it is regulatory, like the Community Reinvestment Act and some of these constraints that exist. How do we change that culture so branches aren't seen as the primary channel anymore? And the reality is you're going to get 99.9% more interactions digitally with your brand today than you ever will with a human face-to-face interaction. How do we change that culture so it's reflected in terms of investment and reshaping the banking market in the US?
I believe from what I'm seeing recently, there are more organizations trying to fix their back office so they can take accounts on digitally in a seamless way. And this is all going to get to a point here where they're going to make it a 3-minute new checking account opening, but then immediate for a loan, immediate for a savings account, where you're not going to have to re-input new documents. That is an extraordinarily major focus across the industry right now. When that happens, and when they've made it so that anybody at almost any organization can open an account on a phone, all of a sudden we're going to see the traffic that currently exists at branches, at drive-throughs, even at ATMs. You're going to see it go down significantly because the way you paid for those branches was not the ATM transactions, it's the new account openings. And if people can do it digitally, the reason why people come in the branch now is we've forced them there because we make it so hard to do the basics. And again, when you start taking away the numbers for why you have to have that branch there, when all of a sudden your new account openings are twice or 3 times higher digitally than they are in the branch. They aren't now because there's been no momentum in the culture to change the old way of doing things. You know, organizations don't understand the business they're not getting because people aren't opening accounts there. They're opening them at Chime. They're opening at SoFi. Oh, by the way, take a look at SoFi and their numbers right now. They're doing better than ever from the standpoint of
Yeah.
shifting to more of a bank platform instead of Rocket. Rocket Mortgage.
Yeah.
Be aware that these organizations, Ally, will continually build their customer base with customers that are frustrated in the old mechanics of the branch-based model. Now,
Yeah.
I'm
Like
usually
to that point,
yeah,
where if a customer says, oh, I mean, a bank says, oh, you got to come in and do a KYC or sign a piece of paper in the branch, then these millennials and these Gen Zs are going to be, forget that. I'll go to Chime, right? Yeah.
right.
So there is a sort of a behavioral
The
differentiation
baby
there.
boomers, the
Yeah.
baby boomers, myself, yourself. The reality is we
I'm a Gen X,
we,
bro.
we may not have closed any accounts,
Yeah.
but we pushed enough
Right. But
buttons to open new relationships,
exactly. Yeah.
and
Yeah.
and it's happened.
I'm actually in the process of closing a banking relationship right now that I've had for 18 years. And I never thought I would close it. I resisted it, but I'm closing it just because it's been so difficult recently from a compliance perspective to keep them happy. And I'm just going to go full digital now.
Yeah,
So,
there will still be branches in the U.S. as long as both of us are living. Their purpose will change. Their numbers will continue to change. And I think I will agree with you. I understand the rationale of some of these big financial institutions, but the reality is I can't support 99.98 maybe percent of the financial institutions for the rationale for building branches.
yeah.
I've learned not to challenge Chase and Jamie very often because it's not it usually ends up being fruitless.
Oh no,
But the reality,
they'll figure it out. But
well,
and once it gets, yeah.
they figured it out overseas. But they, as
Yeah.
as I kid about, they got 30 floors of branch-based people in their New York headquarters that they're going, geez, how do we tell them that we want to
Yeah.
unwind
Yeah.
those branches? You know,
I mean, at some point, it's going to have to happen, right? And
yeah.
look, Chime just crossed 40 million customers. US Bank has 19 million. So it's not like like look, I've often said this. We know who's going to be the biggest bank in Latin America in 10 years because it's them today. It's Nubank, right? And they've got twice the customer base of their nearest traditional competitor. Revolut's going to be the largest bank in Europe this decade. WeBank will be the largest bank in China this decade. We see this happening all over. So to think that the US is going to be immune from this, despite a fairly aggressive regulatory environment against digital players.
Right.
We don't have a fintech charter in the US. It's the only G20 country without a fintech charter, so it's really tough for players like Varo and Chime and others. But they're still breaking through because of the economics. So
Well, and
let's talk about.
we make
Sorry,
these
go ahead.
excuses, Brett. The bankers make these excuses. Well, yeah, Chime's got all those customers, but they're not making money on the customers. Guess what, guys? That was because they were younger. Take a look at their revenue per customer and how it's increased year after year after year. Look what SoFi has done. Look what Varus has done. Why? Because part of the whole idea of making it your primary financial institution is to kick the tires for multiple years. This is a financial relationship. It's not like you're buying a used car. And the reality is, when the people get more and more comfortable, all of a sudden they're going to go, you know what? They want my business a whole lot more than my current bank does. Ally comes to me all the time with new offers that are better than the last. I'm going, eventually, I'm going to give in because they want my business more. Digital organizations can do that because they don't have to keep on knocking on doors. They don't have to wait till you come in,
That's right.
which is really what the biggest
That's right.
problem is. And at the end of the day, we're slowly but surely going to push buttons to make our change known. And all of a sudden, it gets harder and harder to substantiate this big branch with gunmetal in the vault and safe deposit
Yep.
boxes. Yeah.
Well, we did do a super forecast on branching in the United States, and where our forecast came up, and this is off available data from the Fed, is that we're estimating that by 2030, branches will reach the halfway point of the maximum, which was 99,000 branches in 2008. And so we'll be down to 50,000. So, this is within 5 years. But
Right.
what do you said that there's still going to be branches in our lifetime, but like the UK is expecting sometime over the next few years to get down to 2,000 branches. Now it's not as big a market as the US, but
Yeah.
do you expect the decline in branches to accelerate in the US, or do you expect over the next decade or so that it will sort of continue this slower decline that we've seen in the US?
Boy, that's a 60,000 branch question. Um, I think we're going to see it accelerate because I think what's going to happen is the pain of not being digital is going to get greater than
Yeah,
the status quo, the comfort of ongoing profitability. The reality right now, Brett, is I'd rather make money without the cost. I want the spread. The spreads are better now. We're generating deposits now. We're generating loans. Overall, the banking world, from a financial standpoint, is in really good shape, but it's nowhere near where it can be optimally. I look at those credit unions that have zero branches that are all digital, like Alliant in
yeah,
Chicago. Look at Navy Fed, all these companies. They're
yeah.
making a whole lot more money, and their multiples are greater. Why? Because they've solved
They're more
the
operationally cash efficient.
formula.
Yeah.
Exactly. Yep.
Yeah. And, this is even before we start talking about agentic AI. So imagine, you're in a Tesla dealership and you speak into your phone and you tell your agent AI, go off and find me car financing for this new Tesla. And it
Right.
comes back with 3 offers and you go bang. Same for home financing and so forth. OpenAI, Perplexity, these guys are going to be pushing that type of capability, as, your infrastructure, you're
All the
personally the
money. This is
infrastructure.
not going to be
Right.
something they're going to do for free. Exactly. And but the thing is,
Right.
though, that's why bankrate.com, that's why some of these other organizations have so much activity, because people now know I don't have any problem opening a savings plan over in Seattle, because bottom line is it's not like the money actually is going in a Brinks truck anymore from Cleveland to Seattle. So I think, yeah, boy, we could get in this discussion a whole lot on protecting against your lack of digital future. But the way you got to look at it, you want a wake up call. Start looking at your flow of funds. Start looking at where money goes from your best customers and where it's flowing every single month. Most organizations, mid-sized organizations, aren't tracking that enough to know that every single month they're losing business opportunities because they're
Yep.
not digitally ready. And that's why those branches exist, because it's a comfort, it's a soft warm blanket.
And just to emphasize that point, one of the metrics that we repeated in this book that I had in Bank 4 as well is, if you have any doubt about this as a bank operator today, do this exercise. Go and measure how many times your customers have visited your branch this year. And you can do that fairly simply, because you can see when there's a transaction or a sales inquiry, when your ID is entered in the system. So you can track that. And so measure that, not ATM visits. It's got to be a true branch visit where you speak to a human, and measure that same statistic over the last 20 years and look at that pattern of decline in terms of visits to the branch for those types of discussions and engagements. And that data alone, most banks still, I'm astounded, don't measure that as a core operational metric, but that data alone will tell you everything you need to know about investing in digital engagement and digital revenue.
Or you add
So,
one more metric to that, Brett. Find out how many people have gone to your credit card, checking account, or savings pages on your website, because they're not going there because they want to read. They're going there because they want an account.
I don't want to apply.
Those are
Yeah, yeah.
those are potential customers. Now, mind you, there's a ratio and all that, but look at that. Look at the number you just said, the number of people that walk into branch. Look at the number that visit those key pages that are shopping
Yeah.
pages for you. And I'll tell you what, the difference are the losses because you're not getting
Yeah.
customers.
Yeah.
Or simply subtract the number of digital accounts you actually open. And I'm going to tell you, it's not that people don't want to open digital accounts. You make it too tough on them. I mean, I'm going to say that's in 85% of the organizations out there.
Well,
guys, how many years ago was Apple Card? I mean, Apple Card was what, 7 years ago? And it still was only 3 clicks on your phone and it was done. Yeah, that's the bar that's being set.
I got it right here.
Oh yeah.
So, but I never used a physical card, hey, listen, Jim, let's wrap.
Yep.
Hey, first of all, I want to congratulate you on your first best-selling book title. So you are now a best-selling author. Which we knew you had it in you, of course, but congratulations. And, thank you for your contribution. It was invaluable. It's obviously a key chapter in the book. And, I appreciate your friendship over the years and your contribution in this. If you're interested in the book, you can order it now, pre-order on Kindle. Go to branchtomorrow.com for more information about it. There it is. Jim has his copy before I have because mine's sitting back in Bangkok waiting for me to get home.
Mine's not autographed though, so I'm taking it when I see you in a week. I'm going to take it in a heavy autograph.
You can autograph it yourself. But yeah, I'll sign it as well. Thank you for your contribution. And, this is a really interesting conversation. It's an important conversation to have, especially in a market like US where people are very focused on trying to find something to do with their remaining real estate instead of dealing exactly with the issue you've pointed out, which is you have to be digital first in order to survive what's coming next.
Yeah.
On that note,
always, Brett. Love it.
Thanks, brother.
All
right.
See you in a bit.
Check out branchtomorrow.com. Go to Kindle, make an order, and thank you to Jim for his contribution. You're listening to Breaking Banks.